let's now turn to the advisory and talk superannuation now. Of course, the big change this year has all been about Division 293, an additional 15% tax on concessional super contributions. If you earn more than $250,000, but are more people affected, perhaps you'll be caught short. Let's hear from Roger Perrott. He's joining us from Freshwater Wealth. Roger, good to see you again.
Thanks, Anu.
So you say perhaps there is a misconception that there's purely a tax on high income earners. Is that not necessarily the case?
Well, I think, there definitely is this perception that if you earn a high income, you may be caught out. But I think a lot of people, the first time they hear of Division 293 is when they get a letter from the ATO. And that's the first they've heard of it. They've never had it before, and they're wondering, what they can do about it. But unfortunately, if you've got the letter from the ATO, it's all too late. We can't do anything about it. We have to pay the tax. But it is a good reminder that going forward, maybe some better planning, there may be some ways to reduce that tax.
All right, so what's actually triggering that letter and who's at risk?
Yeah, so in terms of the three scenarios, so one is if you do earn a high income, so that's certainly valid. The second one would be if you've received a large bonus this financial year. So in the past you may not have triggered the Division 293, but this year you may. And then the third big one is when you sell an asset, because that income does get caught up in terms of the calculation. So if you've sold like an investment property or sold part of your share portfolio or something like that, that income is included in the calculation.
All right. In fact, we've got some graphics here just to illustrate perhaps these thresholds you need to consider. So just talk us through these.
Yeah, so basically the rules is that when you add your income and your super contributions, so you can see there on the left-hand side, those boxes, if you're over the 250,000, you then have to pay Division 296. So this first example is when you add those two together, the super and the income, is 240. So that's clearly under the 250,000. So there's no 293 tax applicable in that scenario.
All right, let's take it to the next level then.
So the next one here, so this person here has got 260,000 total. So they've got income and super. In this case, they're over the cap. They're over the 250,000. And you can see the proportion over the 250, in this case 10,000, those $10,000 worth of super contributions is then applicable at Division 293, which is 15%. So you can see there that Division 293 is not on the total super contributions, it's only on the amount which is exceeding the total 250,000. Okay,
and to the next slide.
Yeah, so the next one is, we're on a higher income here, so 300,000. So clearly way over the 250,000 cap. And in this case, the total super contribution will be applicable for 293, and that's that additional 15%. So probably just a bit of a recap, when these contributions go into super, it's 15%. The Division 293 is an additional 15%. So I guess you could consider it's 30% now rather than 15%.
And Roger, what options do you have in terms of paying the tax?
Yeah, so in terms of, the ways around it, there's a couple of strategies which don't work. So I guess in terms of, negative gearing, great for reducing tax, but that actually doesn't help in terms of helping the Division 293, because negative gearing is basically excluded. The second thing, super splitting, it may be a good strategy to move your contributions to your partner, etc. Again, there may be other good reasons for doing so, but that doesn't help either. So
why not? Well, how does the ATO treat that?
Just because they're looking at the original contribution, which was the original contribution, where did it land, not where you moved it thereafter. So those, the negative gearing in particular, great strategy for potentially reducing tax, but we can't use it to reduce Division 293. So the other couple of strategies we have is contributing to super is still a good strategy, even though you could say, well, the tax is not as good, it's 30, but it's still better than potentially 47% if you paid it personally or received it personally. So super contributions are still great, but probably the colour's gone off a little bit, or the shine, it's not quite as attractive. The other way is to make contributions on an after-tax basis. So instead of investing personally and generating income, which contributes to the calculation, if we then put those funds potentially in super, going forward that income won't be on your tax return, so it won't be included in the Division 293. So it can help going forward. It won't help necessarily in the year, but super contributions, both of those, are definitely applicable. There's two more. One is if you've got a family trust and you've got income within a family trust, rather than receiving the income from that family trust, maybe it's better to distribute that income to someone with a lower tax rate and obviously away from your tax return, so and away from the calculation for your Division 293. So that's one. And then the last one is just the timing of when you sell assets. So if you've knocked out this year or what have you, or you may be knocked out in the future and get this Division 293, maybe it's just worthwhile considering when you sell those assets and what type of assets to sell. Bit hard to sell a property, go and sell a bathroom, but with shares, if you needed the money or what have you, maybe you could sell part of that, and then we could manage that Division 293 and that 250,000, limit